Hi, my name is Darren Joseph from Tax, and we're the team that seeks to demystify that sometimes confusing world of international tax. And today I want to talk about the Wyden Draft Bill, which some would argue represents an existential threat to the PPLI industry. That's the private placement life insurance industry. Now, we've written several articles and recorded dozens of other videos on PPLI. So have a look at that if you're not familiar. So I had a recent conversation with a client and they were asking a lot of questions about this. So I thought, you know what, let's do some more content on the PPLI. So this year, 2025, obviously has been dominated by the One Big Beautiful Bill Act, or the OBBBA. It's easy to forget back in 2024, we had the Wyden Draft Bill, formerly the Modernization of Derivative Tax Act. It's a draft, right? But it was a legislative proposal from Senator Ron Wyden that aims to dramatically change the tax treatment of certain financial instruments, particularly derivatives. While its primary target was not PPLI, the bill's mechanics would effectively eliminate the core tax benefit that makes PPLI such an attractive tax strategy for the high net worth individuals. Because if it's enacted in its proposed forms, it will render the PPLI structure obsolete from the point of view of tax-deferred growth. So here are four aspects of this proposal that kind of concerns people in PPLI space. Number one, there's a mark-to-market taxation for derivatives. So the core of the bill requires taxpayers to mark-to-market all the derivative contracts for each year. This means they must treat the contract as if they were sold at their fair market value on the last of the tax year. So no more deferral. Number two, realization of gains and losses. Any net gain from this notional sale is treated as ordinary income and taxable in that year. Any net loss is generally treated as an ordinary loss. Ouch. Number three, there's a broad definition of derivative. This bill's definition is extremely wide, capturing not just standard options and futures, but also many swap agreements, forward contracts, and other financial instruments that have derivative-like characteristics. And that broad definition is how PPLI gets pulled into the net. And number four, the look-through rule. The bill contains a look-through provision for life insurance companies. It states that for purposes of the derivative tax rules, any item of income, gain, expense, or loss of a policyholder's separate account shall be treated as an item of the policyholder, not of the insurance company, because that was, again, one of the benefits of PPLI, because it's no longer yours as a taxpayer. It belongs to the insurance company. Not anymore. But it's important to remember that it's just a discussion draft. And what does this draft face? Well, it'll face two things. First will be political hurdles. Enacting such a significant tax change is politically challenging. The insurance and the financial services industry would definitely lobby against it. And a lot of political capital has already been spent on the OBBBA this year. So, probably not going to happen. And then the second thing would be the potential for compromise, as there would be for any piece of legislation. Even if the concept does move forward, the final legislation could and probably would be watered down, including hopefully grandfathering clauses for existing policies to modify that look-through rule. Again, to find out more about PPLI, visit our website, hej.tax. My name is Darren Joseph, and we will see you next time. Bye.